You're looking at Microsoft stock trading near $400, wondering if it's finally time to pull the trigger. The company seems unstoppable, cloud dominance, AI everywhere, that steady dividend, but the valuation makes your stomach turn. Here's what most retail investors miss: the question isn't whether Microsoft is a good company, it's whether the current price makes sense for where you are right now. I've spent the last decade analyzing what separates winning tech investments from the disasters, and Microsoft keeps showing up in the portfolios of investors I respect. Not the flashy day traders, but the quiet billionaires who compound wealth over decades. Ray Dalio holds it. Bill Ackman holds it. Even George Soros has a position. But here's what caught my attention recently: the stock just gained 3% in a week where analysts were actually cutting price targets. That's not normal market behavior, and it tells me something deeper is happening that most people are missing. Let me walk you through why these billionaire investors aren't selling, starting with the most obvious reason: Microsoft's cloud business is a money-printing machine. Azure is the #2 cloud platform globally, and it's still growing at double-digit rates while generating massive margins. But that's just the foundation. What excites me more is their AI integration across every product line, from Copilot in Office to AI-powered search in Bing. They're not chasing AI trends, they're embedding AI into products that already generate billions in recurring revenue. That's the kind of moat expansion that creates decade-long winners. But the bullish case gets even stronger when you look at the technical setup. Here's where it gets fascinating from a timing perspective. The MACD indicator just turned positive at 3.17, which typically signals upward momentum building. RSI sits at a neutral 53. 43, not overbought, not oversold, just balanced and ready for the next move. Our AI analysis is showing a bullish signal with medium confidence, projecting a target of $410 from the current $397. That's about 3% upside, which might not sound like much until you realize this is happening right before earnings. Speaking of earnings, there's a catalyst approaching that could change everything. Microsoft reports earnings on July 29 after market close, with analysts expecting $4 per share. But here's what matters more than the headline number: Wall Street will be laser-focused on Azure growth rates and AI adoption metrics. If they can show that Copilot is driving meaningful Office subscription upgrades, or that AI is accelerating cloud migration, this stock could break out significantly. The smart money seems to be positioning ahead of this catalyst, which explains why the stock is holding strong despite those analyst downgrades I mentioned. However, this optimistic picture comes with real risks that could derail the entire thesis. Let's be honest about the risks, because they're significant. First, valuation: Microsoft trades at a premium that assumes everything goes perfectly for years. Any disappointment in AI monetization or cloud growth could trigger a sharp sell-off. Second, competition is intensifying. Google's cloud business is growing faster, Amazon's AWS still dominates, and we're seeing new AI competitors emerge monthly. Third, and this is the big one, regulatory scrutiny is increasing. Big tech is under pressure globally, and Microsoft's market position makes it a target. If regulators decide to limit AI integration or force business unit separations, the entire investment thesis changes overnight. So why do investors like David Tepper, Cathie Wood, and Terry Smith still hold Microsoft despite these risks? I think it comes down to three factors. First, they're betting on the duration of Microsoft's competitive advantages. Once enterprises adopt your cloud and productivity stack, switching costs are enormous. Second, they see AI as an expansion opportunity, not a threat. Microsoft has the enterprise relationships and the infrastructure to monetize AI at scale. Third, and this is crucial, they're not buying Microsoft for the next quarter or even the next year. They're buying a company that should compound wealth over the next decade. But that doesn't mean the stock can't disappoint in the short term. Here's what would change my mind in either direction. On the bullish side, I want to see Azure growth stabilize above 25% and concrete evidence that AI is driving pricing power in Office. If they can show that Copilot users are paying meaningfully more, that validates the entire AI investment thesis. On the bearish side, I'm watching for any signs that cloud growth is decelerating faster than expected, or that AI integration is cannibalizing existing revenue without generating new income. The upcoming earnings report should provide clarity on both fronts, but remember, one quarter doesn't make or break a long-term investment thesis. Look, Microsoft isn't going to make you rich overnight, but it might compound your wealth steadily over time if you can handle the volatility and valuation risk. The case for holding or buying centers on their AI integration and cloud dominance. The case for selling centers on valuation and competitive pressure. What matters is how this fits your specific situation and timeline. For the complete analysis including our AI signals and technical indicators, check out nexusaicalls.com. And remember, this is educational analysis, not financial advice. Do your own research, understand your risk tolerance, and invest accordingly.